In this chapter, chapter 10, we're going to be looking at the idea of life insurance. We've been talking about how to protect our stuff with automobile and homeowners insurance. We've talked about how to protect our health with healthcare insurance and disability insurance. Now we're talking about protecting our life, okay, with life insurance. Um, See the learning objectives that we have for it. Now, the whole idea behind life insurance is it's not for you. If you're buying a life insurance policy, it's not for you. If you die, you don't care as far as having the money that goes along with it. The whole idea behind life insurance is to protect the people that you love, the people that might be a part of your family or something along those lines. What you need to do is think about how you are going to actually use that money when you do pass away for some reason. What you do is you're protecting somebody else, and you could also do it for other things. In other words, paying off a mortgage. If you pass away, you have a family, you still have a mortgage, you can use that life insurance to pay off the mortgage. Maybe what you do is you set up an endowment for your kids or something along those lines. Maybe you don't have a family, you want to make a charitable contribution. These are some of the reasons why you might want to purchase a life insurance policy. Now, what they do is they determine how much it's going to cost you based on your age primarily. What they do is they have these mortality tables that says, okay, if you are this age, you are expected to live this many more years. The older you are when you purchase a life insurance policy, the more it's going to cost you. The sooner that you buy one, as far as your age is concerned, the less it's going to cost you. So in the book, it shows you some examples of some life expectancy tables, and this is from 2012. And they're going to change a little bit from every year. And as you can see there, in 2012, if you were a male, you were expected to live on average 76 and a half years. If you're female, you're expected to live a little over 81 years. Women have a tendency to live longer than men. All right. And so you can see that what they'll do is they will base the rate as far as your life insurance policy on your life expectancy. The longer you're expected to live, the less it's going to cost you. Now, the thing you have to think about when you want to buy life insurance is, why are you doing it? Okay. What is your need at this point? Do you have a family that you want to protect? Do you have parents that are reliant on you that you want to protect, or something along those lines? When trying to figure out how much life insurance you should purchase, there's several methods that you want to use. First of all is the easy method. Okay, so in other words, think about how much you're making right now, 70% of your salary for 7 years. So let's say that you're making $100,000. That would be 70% of that would be $70,000 for 7 years. So in other words, about $490,000, or about $500,000 in life insurance. What's that do? What that's doing is assuming that you have your typical family, married, 2 kids, that sort of thing. Another way of figuring out how much you should buy is the dual income, no kids method. In other words, you're assuming that you and your spouse are making about the same amount of money, so the amount of life insurance that you want is enough to cover your funeral plus half the debts. So if you have a $100,000 mortgage that's left, you're saying, okay, 50% of that, so that would be $50,000, and then your funeral, which might be about another $10,000. So maybe $100,000 would be plenty as far as life insurance in the dual income, no kids method. Then you have the non-working spouse method. In other words, you think about the youngest child, how many years until that child reaches the age of majority, which is 18 years old. And so, okay, so how many years is that times 10,000? And honestly, let's say that you have a couple of kids. One's 14 years old. There's only 4 years until that youngest one hits 18. And that's only $40,000 worth of life insurance there. And so one of the things to think about is, I said, now I'm not big on this method right here, because I think what it might do is underinsure what it is that your family might need. Now, you have 2 different types of life insurance policies, okay? You have your stock life insurance and your mutual life insurance. Your stock life insurance company is owned by shareholders. It's a corporation, all right? And the type of policies that they provide are what's called non-par or non-participating. Mutual life insurance policies are owned by the policyholders, and they have what's called participating policies. If you remember back when we were talking about banking, okay, and saving and things like that, we talked about commercial banks and we also talked about mutual savings and loans. Remember, commercial banks are owned by stockholders. It's a corporation that's owned by stockholders. Mutual savings and loans are owned by the people who actually bank there, who have their savings there. So just like that, same thing with life insurance companies. The policyholders own the mutual life insurance company. Shareholders own the stock. Now, with stock life insurance, about 3/4 of all of the policies that are written are from stock life insurance companies. In other words, they're non-participating or non-par. What happens is you purchase a life insurance policy. You're going to pay that same amount for the rest of your life if it's that kind of a policy, or until you hit 65 if it's that kind of policy. You'll see that here in a bit. And so you just pay the same amount every month, every year, as far as that life insurance policy, as long as you've held it. With a mutual, which is about 1/4 of all of the insurance policies that are written, what's happening is you're participating in the profits of the company. So what happens is, as the company makes more profits, they will give that back to you as far as a policy dividend, just like with the savings and loans and things like this. So you have to think about what kind of company that you're dealing with. So, for example, there are, one of the things you can do is go out to the net and you can look and see what kind of insurance companies are stockholder held, which ones are mutual. For example, Mutual of Omaha is actually owned by the policyholders. Some of the other life insurance companies, so for example, State Farm, is owned by stockholders. Now, you can get different types of insurance policies. You have term, whole life, group life, credit life, and endowment life. Term life is just pure protection, all right? It is good. The policy that you purchase is good for a certain number of years, for a certain term. So you might have like 5-year or 10-year term as far as your life insurance is concerned. And what happens is you are protected. In other words, you could receive the face amount of that life insurance policy if something happens to you, if you die. If you stop paying on that, it all goes away. All right. Now, there are different types of terms. So in other words, you have your renewable, multi-year conversion, this sort of thing. Straight life is whole life. In other words, what happens is with straight life or whole life, what happens is you are going to pay the same amount every month as long as you keep that insurance policy. A portion of that payment that you make is actually going to kind of a savings account. So it's actually generating a cash value. You can borrow against that cash value. Now, the thing is, it takes a while for any cash to accumulate, and the returns on that are really pretty thin. The thing is, it does give you a little bit different view versus the temporary or the term life. The term life, let's say that after 10 years, you don't renew that, it's gone. All right. You no longer have the life insurance policy. And when you do renew it, the cost is going to be higher because you're now older. With straight life or whole life, what's happening is it stays the same amount as long as you keep it. Now, with whole life, you can have different policy options. So in other words, you could have a limited payment. In other words, what you do is you say, okay, I'm 30 years old. I'm going to retire at 65. So for the next 35 years, I'll pay on this. And at the end of that 35 years, it's considered all paid up. You don't have to pay on it anymore. And you still have the face amount of that policy. The thing is, that's going to cost you more than the regular whole life. Now, you have variable life. In other words, you have a minimum death benefit. The thing is, there can be some changes as far as it could go up or it could go down, but there's going to be a minimum as far as that life policy is concerned. So the face value of it can change based on how much you put into it, based on the profits of the company, things like that. Adjustable life is where you can change the premium payments. And so one of the things you can do is you can change the payment amount that you have, and it could possibly reduce the face value of the policy. Universal life is kind of a cross between term and whole life, where it's good for a term, but it's generating and holding on to a little bit of a cash value. Now, the other types, group life insurance. You go to work full time, one of the benefits that they're going to have is group life insurance for the most part. Most companies have that. It's term insurance. There's a certain amount of it that is paid by the employer, and you don't have to have a physical or anything like that. You don't have to prove that you are insurable. And I'll tell you something, folks, it's cheap. It's cheap. Most companies will set it up so that you have a certain amount of term life insurance. It might be one times whatever your yearly salary is. So if you're making 50 grand a year, you might get $50,000 in term life insurance through that group policy that the company has. Most companies then have the opportunity for you to buy up. So for example, you could go maybe double that. And so you would pay a bit of a premium for that group life insurance to have the 100,000 instead of the 50,000. Credit life insurance is a ripoff. In other words, one of the things that they might get you to do, try to get you to do if you buy a house or something like that, is try to get you to get credit life insurance. So in other words, here is life insurance to pay off this mortgage, and specifically only for that mortgage. The thing is, it's pretty expensive as far as that's concerned. Endowment life is basically where you have coverage for just a certain amount of time, and it pays to you if you're still living at the end of that period. So for example, if you set it up so that, okay, I'm going to pay it off until I'm 65, and at the end of 60, when I hit 65, you pay me the amount of that. You can have the endowment life. This exhibit shows you kind of the differences between term, whole, and universal life. Go back to the text and review that. Now, there's some things to think about when you are purchasing that policy. First of all, you have to name your beneficiary. Who is going to receive the proceeds if you pass away? And you'll probably want to have contingent beneficiaries. So, for example, when I set up a life insurance policy, I named my wife as the primary beneficiary. If something happened to her, then it went to my kids. You have an incontestability clause. In other words, after a certain length of time, the company cannot dispute the validity of that policy for any reason. You have a grace period. One of the things you want to look at is what kind of grace period is there? Is there 30 day? Is it 60 day? Whatever it is. In other words, you miss a payment. What kind of grace do they give you before they cancel the policy on you? And then what kind of a reinstatement statement that they have in there in case that policy did lapse? Do they have to? Do you have to have another physical, or will they pay off the cash value that you have? You also want to think about the non-forfeiture clause. In other words, you get to keep the accrued benefits in a whole life policy if you drop it. So, for example, let's say that you've had a whole life policy for 20 years. You build up a $10,000 cash value. You cancel the policy, you get the cash value back. Misstatement of age provision. If you give them the wrong age, they can cancel the policy on you. Loan provision, you can borrow against the cash value that you've built up in that whole life policy. Suicide clause. In other words, you get yourself a big old life insurance policy, and then you blow your brains out within the first week, they're not going to pay off. Riders, or policy rider, is basically something that's modifying the insurance policy based on whatever it is that you're asking for. So it could be things like a disability benefit. If you have this policy, this life insurance policy, and you become disabled through an accident or something like that, you can't work anymore, they will waive the premium for the rest of your life. And so they'll consider it all paid up. Accidental death benefit. A lot of times what they have is what's called double indemnity. You have a life insurance policy. If you die of natural causes, you get the face value. If you are killed in an accident, say a car accident or something like that, they pay double. That's the accidental death benefit, double indemnity. The guaranteed insurability option. In other words, if you want to increase the amount of insurance you have, they are guaranteeing that you will be insurable. They'll go ahead and do that. Cost of living protection is basically where they are bumping up the face value of the policy based on increases in the cost of living. Accelerated benefits, in other words, if you become terminally ill before the time that the policy is set to expire or whatever, you can go ahead and pull that policy. So these are some of the benefits to think about. Now, when you're buying life insurance policy, folks, shop around. Shop around. You have to think about, okay, so how much am I actually going to need? Who is it that I need to protect? What kind of group life do I have? Can I just use group, or do I need to have a policy that's outside of that, a personal policy? What kind of security benefits will be there? Things like that. You also want to think about how good of a company it is, because you can go out and check out things like AM Best and Standard & Poor's to find out, is this a strong company? Are they paying off on their policies? Things like this. So shop around, ask people, ask your family and your friends and things like that, who it is that they bought theirs from, because it's not only the policy, it's also the insurance agent that might help you with that. Because you want to find out, is that agent available? Okay, do they advise you about your financial planning? Are they putting the arm on, twisting your arm, trying to get you to buy a particular policy and things? Are they willing to take the time to answer all of your questions and make sure that you're finding the right policy for you? You also want to compare costs. Okay, there's going to be different costs that go with the different types of policies and with the different companies. So whenever you're thinking about buying life insurance, you want to get the policy and look it over. You apply for it. They will accept you or not. You have to provide your medical history. They may want to get you to take a physical and have it verified. You get a 10-day free look at that policy. In other words, you apply for it. You say, okay, there it is. You make your first payment, and you have 10 days to look over this policy and make sure it's right for you. Read every word of it, folks. If you don't want it, you can cancel it at that point in time. You also have to think about how the money is going to be dispersed in case you do pass away. In other words, what most people do is they have a lump sum payment. So in other words, if you have a $100,000 policy, you have the same thing set up for your spouse. What they'll do is they'll give 100 grand to your spouse. You could have a limited installment plan. So in other words, okay, what we're going to do is distribute the funds on that over a 10-year time frame or something like that. You could have the payments to the beneficiary for their life. In other words, what happens is what they'll do is they'll just start providing payments off of the face value of that policy to whoever it is that you have set up as your beneficiary. Be careful about trying to switch policies. In other words, you have a policy, let's say you buy one at 25 and you start thinking, okay, I'm 32 now, I'd like to get a new policy. It's going to cost you more. So you really have to think about, okay, is this really what I want to do as far as this policy is concerned? Do I want to get rid of this one and buy a new one, or do I just want to buy more life insurance, another life insurance policy? Another thing to think about is financial planning with annuities. Now, an annuity is basically where you're buying kind of a life insurance policy and you're paying into this sucker. And what happens is when you retire, it starts paying you back. And so life insurance companies do quite a bit with annuities. Now, you have to make sure that all of your other stuff is funded before you buy an annuity. And the reason is because annuities are not going to give you as much of a return as some of the other investments that you could possibly have. So with an annuity, you basically have this contract where you say, I'm going to pay you every month this amount, and it builds up over time. And then you start withdrawing on it when you retire, and it starts paying you back. That's all we're going to do as far as annuities. There's a lot more information that goes along with it. If you have questions as far as this chapter is concerned, give me a shout. We'll talk about it.